What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about a brand new stock, company that I've never covered on the channel. It's rallied over 200% since October, November 2022. I've been getting a couple questions on this company. It is a IoT stock, so it's called Samsara. Hopefully I'm pronouncing it the right way. We're going to take a look at the earnings. We're going to take a look at the investor presentation. Intrinsic value calculation will be included. And of course, the technical analysis as well, because it's trading at an all-time high at just over 30 bucks a share. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join. And also don't forget the fundamental technical analysis courses, as well as the options course. 50% off right now, individual courses, and the bundle, which is the best value bundle, 60% off. Coupon code is going to be labor4 if you are interested in, of course, taking advantage of this sale. This does expire tonight, so after midnight tonight, this coupon code will expire and go away. So links are going to be down below if you're interested in joining and taking advantage of this sale. So when it comes to Samsara, it is a connected operations cloud, so it's an IoT company, right? Internet of Things. And basically what it does is, if you go over to the highlights here, that's going to be this one right there. So it is a company that's develops the Internet of Things, IoT connected sensor systems. The company's products and services help businesses manage their vehicle fleets and industrial operations. We got sensor hardwares, we got cloud software, and we got mobile applications as well. And it is, again, a fairly new sort of company in stock. It's only gone public in December of 2021, and I believe it was started in 2015. So it's, again, it's a fairly new company, trading at an all-time high, just under $31. On Friday, the stock was up 31%, and since October of last year, it's up over 276%. So very significant rally here, trading at just over $16.4 billion market cap, but it's not profitable. So we'll get to that in just a minute. So when it comes to net new ARRs, that's your average, or that's their annual recurring revenue, $74 million, 33% growth as of the second quarter of fiscal year 24. This right here is going to be their annual recurring revenue of $930 million. Every single quarter they've been able to grow. So not only are they growing sequentially, but year-over-year growth of 40%. And GAAP revenues is sitting at $219 million as of the second quarter of fiscal year 24, 43% increase on a year-over-year basis. But top line numbers are growing very, very nicely. When it comes to customers, so over $100,000 plus annual recurring customers are sitting at 1,515. That's a 53% growth year-over-year. That makes up over 50% of their core customers. 5 to 100,000 is going to be that next at 46%, and less than 5,000 is going to be 4%. So, it's kind of spread. Over half of the revenue is coming from 1,500 customers that make up over $100,000 in annual recurring revenue, and the rest is going to be from 5 to 100,000, varying from very, very small to small. Now this right here is going to be profitability. And because the company is spending a lot of money on SG&A, R&D, their operating income obviously is an operating loss right now, but it's moving in the right direction. I think that's really what the market wanted to see. That's one of the reasons why I think the stock is moving in the right direction, is because earnings came out and they reported some pretty strong beats on revenue and EPS. And it also did show that they are moving in the right direction when it comes to operating efficiency and just improving profitability. So non-GAAP gross margins at 75%, very, very high, because you'd expect it's a software company. Non-GAAP operating margins at -3%, but again, moving in the right direction. And adjusted free cash flow margins positive at 2% for the company as of the second quarter of fiscal year 24. So I think that's, again, one of the reasons why the stock is up substantially, is because of these numbers. And total revenue expected at $896 to $900 million. I think this guidance was also raised, and 37 to 38% growth year over year. And non-GAAP operating margins at -3%, and non-GAAP EPS, earnings per share, expected to now be profitable at pretty much break even to 2 cents per share for the company. So as you can see, every single metric growing in the right direction here, but also is the SG&A and R&D expense. And as a result, operating losses are piling up, and net losses are also pretty substantial at $240 million. And the shares outstanding have also gone from 230 to 524 million, right? So they've pretty much more than doubled in the last couple of years. So gone from 277 to 524 million shares outstanding since February of 2020. So if you plug in that number here, 244, and that number has grown to 524. Let's see, 230 to 524, and it's since 2017, I believe. So 2020. So 2020, that's a growth rate of 31.5% in share dilution. It's a pretty substantial number. 72% gross margins. Everything else is obviously negative because the company's not profitable yet. They do have a pretty strong and pretty solid balance sheet at $724 million worth of cash with about $105 million of debt. So net debt is going to be negative at negative $618 million. And the current and quick ratio is over 1 to 2. And we got debt to free cash flow at over 5. We look for this number under 3, but they've got more cash than debt on the balance sheet, so we can kind of ignore this number. When it comes to valuation, very, very high, incredibly rich stock, trading at over 20 times sales. We got price to book at 17 to 19 times, and price to cash flow at over 773, and we don't have a price to earnings multiple on a non-GAAP basis, forward basis, trading at over 1,734. So needless to say, the valuations are very, very high. It is a very expensive stock trading at these valuations. Earnings expectations from 2 cents to over 17 cents by 2026. So if you plug in those numbers here, it's going to go from 2 cents to 17 cents by 2025. We're looking at a growth rate of about almost 200% for this stock. So that's going to be a very substantial high growth company. But again, we have to be more conservative, more realistic with our approach. And we also don't have free cash flows. So we're going to plug in 0 all the way over here. So we don't have a free cash flow to account for. So when it comes to net income, $10.4 million expected. Share count's 524. So that gives us an EPS of about 2 cents per share, and we're gonna plug in a growth rate of about, let's just do 50% to start with, and of course we're gonna plug in some of these other numbers as well. So P multiple, let's just keep that PEG ratio intact. Let's just go with 50 times P multiple. Free cash flow and the free cash flow multiple we can keep 0 because we don't have positive free cash flow. So we're gonna pretty much give the EPS 100% weighting over the calculation of our intrinsic value. The discount rate is going to be 12%. I'm going to do 10% margin of safety. I'm going to do 10% share dilution because of how much shares I've issued in the past. And we get down to a fair value of close to $241. And right now it's trading at about $31. And the reason for this massive discrepancy is primarily because of the valuation, right? Trading at an insane valuation. So let's say if I go with 200 over here, then you'll notice that the valuation jumps to over 963. And the growth rate, of course, if I go with, let's say 100%, then the fair value jumps to over $40, right? So those are pretty substantial numbers. So obviously we're not gonna do that. We're not gonna go crazy here. So 50 and 50, I think, is a lot more reasonable. Maybe even 75 for that growth rate, and that gets us to a fair value of about $3 or $4. So bottom line is that I know there's a lot of excitement around this company. There's a lot of hype around this stock because it's pushed up so much. But I would be careful if you are trading this because it can be very volatile. Profitability is still questionable for this company eventually, if and when it actually does turn profitable and more consistently it's growing revenues and whatnot. Then we can take a look at it from a more serious analysis basis to better understand what the actual true intrinsic value might look like. And of course, we're still waiting on the free cash flows to turn profitable positive as well. So hope you guys enjoyed this video. Resistance is going to stay put at $31, $32. So this right here is going to be that resistance level to watch. Right now, we don't really have a support. Instead, we do have a very nice consistent higher lows. So this right here is going to be that level to watch. And there is a little bit of an ascending triangle formation. So I wouldn't be surprised if you do get a huge breakout over $30, $31 per share for Samsara for it to be trading at an all-time high eventually. So let me know in the comment section down below, what do you think about this company? Are you buying, selling, holding? What are your thoughts? If you have any insight into this stock, let us know down in the comment section below. For me, I think it's it's very expensive right now, so I'm not going to be super interested. But as always, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. Don't forget, we do have the fundamental and technical analysis courses, as well as the options course. Currently 50 to 60% off. Coupon code is going to be Labor4. And this does expire tonight after midnight. As always, happy investing. I'll see you all in the next video.